Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elkana, along with Brianna Valesky. We have Nate Tobik on the line. He's an investor and founder of CompleteBankData.com. Nate, how you doing on this Wednesday morning?
I'm doing well. Thanks for having me on again. So it's been a little bit of a crazy market for bank stocks here the last couple of weeks.
Yeah.
So
Let's go back to it there on the flash crash Monday. Were you prepared? Were your systems doing okay? Were you able to get some good purchases? How'd it go for you?
so yeah, I didn't purchase anything. Was definitely watching closely though, and it's been an interesting market for these banks. So the larger banks have, they fell with the broader market, and we saw some crazy movement there. But what's really fascinating is a lot of the small banks were almost unchanged, and I don't know if that's a function of computerized trading or a function of liquidity, but it's I was hoping for a lot more deals in a lot of these smaller banks, and they're almost unchanged. But for an investor who was looking to get into, say, Wells Fargo or maybe JP Morgan, now's the time to buy at January's price.
So some of these smaller banks didn't really react. You think it was just kind of liquidity? Could you give us an example of one of these banks that you're talking about that really didn't have the reaction, to the downside?
Sure, let me pull one up here. So a good example would be maybe like America's United Bank. And so if you look at them, I mean, their chart
Symbol? Can
is,
you give me a symbol, please?
yeah, AUNB.
Okay.
And so, in August they hit 740, but they're around 715 right now, and there's really no dip in the chart. Uh, so it's relatively flat, and it's actually up about a buck a share over June and July.
That one didn't come up for me. You got another one?
Let's see here. Um, Maybe FAPB.
FAPB. Let's see. Okay. Huh. For some reason, are these over the counter? Huh.
I think so. Yeah.
Okay, so you
Yeah.
at the top, or you just said, now you got a chance to buy your Wells Fargo here at January prices. I know, I believe it got an upgrade yesterday. Also had some favorable ink and Barron's. I mean, it's already just had a monster run here. You think that still room for upside? What are you basing that on?
Yeah, well, so the largest banks have a lot of momentum behind them in that their numbers are so big and they're pretty much growing with the economy. They're going to continue to print money. And as a lot of these regulatory issues start to fall by the wayside, earnings are going to there's going to be a natural increase. Whereas when you start to step further down in the bank size, inside the industry, these banks they're having to work to increase their earnings to fight some of these regulatory headwinds. Whereas I think maybe one way to look at it is to say the Bank of America had their largest regulatory headwind coming out of the crisis. It'll never be as bad as it was back then. So it's only going to get better. Whereas a smaller bank is now getting the crackdown from regulators, and the regulators are going over the loan paperwork, and are all these things in order, and are all your systems in compliance? Look at your cybersecurity, is that in compliance? And so there's a compounding factor for the banks that aren't the largest banks, where some of these regulatory expenses are increasing, and so there's some pressure there. And so at the high end, you have a bank that this regulatory factor is decreasing, and then at the lower end of the spectrum, this factor is increasing. And I think that's a lot of that is driving the M&A boom in smaller banks.
Okay, all right. Goldman Sachs got an upgrade today and approaching the 190 level. That Goldman Sachs and Morgan Stanley, you're like only investment banks that still left for a financial crisis. It's bounced, coming back up to the rebound highs here. Give us your take on Goldman Sachs.
Goldman Sachs is interesting, and I think we discussed in the past their entry into some of the peer-to-peer lending. And that's I think that's going to be a big sector, a growth sector. Um, well, it's intriguing to me that they're moving away from some of the traditional investment banking and trying to diversify. And I don't know what that says long term, um, but there's only two investment banks, traditional investment banks left when there used to be a lot, and I don't see some sort of a startup boom in investment banks. So maybe this is kind of a way to say that the industry is on a downtrend. I don't know, but
Mm-hmm.
it's an interesting data point.
Okay, and I guess the same would be go for Morgan Stanley.
I think so. Yeah, they pretty much trade together for outside of what happened back in 2008 when Morgan Stanley had a lot more missteps than Goldman Sachs.
Yeah, well, they both had quite the discount in price back then.
Right?
Coming out of the chat here, do you follow BANC at all?
Is that the Bank of California?
Yes.
So this has been on my radar. I haven't had time to dig in, but they've been hitting the top of a lot of screens that I've run. So I guess what that would say is, they're getting pretty cheap, and they're probably worth a real good look at this point.
Okay. All right. Taking a look. It's just like it's been bunching up, and I looking at this chart here on Flash Crash Monday. I see it traded, but not that big red bar that you see on a lot of these other issues. Regions. Is there any regions of the country where you think the banks are due to prosper a little bit? I know that the oil states have held up fairly well. Texas and some of the southern states. Any regions you're looking at?
Yeah, I don't know if the traditional forecast, you say the oil. I think in theory you'd say the oil states the banks shouldn't be doing as well, but that's not necessarily true. And then you'd say maybe in the Rust Belt states the banks should be doing poorly. But I'm not sure if that's necessarily true. It's what's been happening is there's really been this stratification in that there's banks that have learned how to deal with the market environment and learned how to handle volatility, and then there's ones that have not. And the ones that have not are ended up they're now in the M&A cycle, and so these guys, the bankers, are fatigued. They're tired of these quick up and downs. So if you think about, there's always been a boom and bust cycle, but now it seems like we have these boom and bust cycles quickly and often. So, 2 years ago, a year and a half ago, you say, oh, oil, everything's kind of going well with that. And then suddenly the bottom falls out. And it seems like that's happening more quickly now, at least. And maybe that's just a feeling. But in terms of M&A, it's kind of interesting. I saw an article come out late last week that was talking about this. And it's, so we're on the trend on M&A is about the same as last year. There's been 183 deals this year versus 181 last year. And the the median price to tangible book is about 136%. But what really fascinated me is the aggregate value of those 183 deals is only 10.9 billion. So almost all of these deals are very small banks. I think the biggest deal was a $5 billion bank. So there's essentially 182 banks that together are worth about $5 billion that were merged. And so it's really at the low end that we're seeing all this activity, and these are the guys who can't react. So if you have a bigger bank, say Regions Financial, because they're in the South and they have some exposure to the oil and gas, or some of these larger Texas banks, they have the portfolio to weather a storm. But if you get a real small bank, I'm just making up a name here, it's like a Louisiana Community Bank, they're not going to have the balance sheet to really weather that storm. And so what ends up happening is they start to hit a bump in the road. The executives are fatigued with the regulatory issues. They say, you know what, it's time to get out of banking, and they end up selling. And I think that's where the opportunity is for investors, and finding some of those smaller banks where they aren't perfect operators, but at the next sign of trouble, they're just going to sell.
Okay. All right. Any candidates? I mean, any symbols for us to take a look at?
Yeah, so what was interesting is the median multiple is 136% of tangible book. But one bank, the highest FBC bank shares went for 389% of tangible book. And so I took a look at them and wanted to see what was different about them. And they're about a $300 million, $380 million bank. So they had a high net interest margin of about 4.7%, a lower efficiency ratio of 66% for a community bank, a return on assets over 1%, a return on equity of 14%. So I just ran a screen, and there was probably maybe 20 some banks that came up on this screen of matching candidates. And so I've got a list of four here
Okay.
that are all around book value, all about 10 times earnings, and all hit this criteria. So we have SMAL, that's Summit Valley Bank Shares, I believe.
Yep.
And then VCBP, FABP, and NIDB. And so these are all decent little banks that are all trading. They should probably be worth 30 to 40% more at a minimum if they're going to trade in line with the market. But for how good of an operator they are, if they do decide to sell out, it's possible they could go for double.
And why? What's the street missing on these? Are they just smaller operations? They fly under the radar, and are they any particular regions?
It's really an under the radar thing. So a lot of these banks are traded over the counter, and most investors aren't interested in anything over the counter. You might have to wait a couple hours or a day or two to get a fill on your shares. And sometimes it's harder to get a larger fill. You'd have to talk to a market maker to arrange that. But these banks are they're boring and they're under the radar, and there's no interest in. But there's no interest from the market itself. What's interesting is there's interest from other bankers. So there's this active private market where these guys are looking for acquisition targets, and investors ultimately benefit.
Okay. All right. Just any thoughts here on the September rate hike? Is that something we're going to be seeing? I mean, is the market just kind of forcing the Fed's hand to maintain some credibility? What are you thinking? I thought last time you were on, you were thinking that it's going to go through. What are you thinking now?
Yeah, I I would have said maybe back late July. I was um, more positive than negative on a rate hike. It's tough because I think the market is trying to force the Fed's hand, but I think it seems like the Fed is so tentative on this rate hike that they're almost looking for any excuse to not hike rates. And so with the jitters in the global market, I could almost see them pulling out an excuse saying, we're not sure with what's going on with China, what's going on globally, if we want to raise rates at this point. And the last guest made a great point, which is when rates go up, the dollar goes up too, and that's going to be an issue. So I don't know if they'll be forced into something, and if they are forced into it, it could be just a very small hike. And I think everyone's expecting something. It's a magnitude of how small that could really be.
Yeah, I mean, if you think about some of these big companies like Procter and Gamble, that I mean that stock has been hit, primarily on its dollar exposure. I mean, already a slowdown. I mean, the economy's moving, but not very fast. I don't know. Another rate hike. I mean, another possible reason people talk about it is, well, they're taking them up, so if things really go flat, then they can take them down again. Do you subscribe to that theory?
I don't. I think if anything, if there's any problems again, I think they're just going to go back into the quantitative easing, and that's really the only weapon essentially they have left. And if you say they went up a quarter of a point, I don't think going down a quarter of a point is going to do all that much. So, maybe there's a psychological aspect to that, but just moving up so they have the ability to move back down, I don't think that would provide all that much relief.
Okay, all right, and just any banks here that maybe had to wash out, rebounded, maybe a little bit frothy up here, and something maybe that investors should take a look at, maybe taking some profits in, or maybe not taking profits or shorting, maybe just keeping a look at to see if there's any continuation move on the upside.
Yeah, so in terms of taking profits or even shorting, it's been interesting because there are some of these banks that have just really shot up. I'd say I like the it's not a traditional bank. I like the idea of the peer to peer and the lending club, and we've talked about that in the past. But I'd say if you look at lending club on a banking multiple, which is essentially they're essentially a banking light model, they're kind of in the stratosphere, and all banks would love to trade like they do, and bank investors would love those sort of multiples. But I don't know if that's sustainable necessarily. And then there's some other, the market is overvaluing banking growth. So a bank like Bank of Hawaii, they're trading at a very high multiple just because they've been growing and have good numbers. But I think the multiple is not deserved for the type of the type of operational metrics they have.
What's the symbol on that one?
It's BOH.
I could have guessed that one there. Okay, Bank of Hawaii. Okay, all right, getting a little bit bump off the lows, and then just just before we let you go, you did a little talk about Bank America here, and you said that the things really can't get any worse for it than it did since the financial crisis. Here you are trading at 1650. Looks like a potential resistance area here in the short term. Could you give us your long term outlook for Bank America?
Yeah, I think Bank of America and Wells Fargo, I think of them similarly in that I think eventually we're going to get to a point where these are almost like utility stocks. And so if you figure, say, a 5 or 6% dividend plus a couple percent of share buybacks, and that could be a huge yield for investors. It's just a matter of hanging on until we get there. So they're able to cut costs. There's definitely a lot of fat at some of these banks, and they've also got the advantage of scale. So when you've got $1 trillion balance sheet, it's a lot easier to grow by a few $1 billion compared to a bank with 300 billion that's trying to double.
All right, before we let you go, tell us about your site, CompleteBankData.com, and also OddballStocks.com.
Right. So Complete Bank Data is a banking analytics package, and it's great for idea generation, for researching banks. You can find it at CompleteBankData.com or on your Bloomberg. If you have a terminal, it's Apps Banks Go. And so, that's kind of how I monitor the market is through this app. We've got some screens that continually refresh, and it automatically values banks. And so I'm kind of watching where banks fall. And then I write on oddball stocks really about companies that are off the beaten path. And a lot of these are over the counter traded or obscure situations or value opportunities that a lot of the market might pass up. So it's a lot of it's entertaining. A lot of the ideas are small, aren't necessarily extremely actionable, but for a personal account or a smaller fund, it's definitely good hunting ground.
Do you have one on the oddballstocks.com that's I'm not pulling up all the OTC stocks. Is there one that I could perhaps pull up that's on Nasdaq or New York?
Um, I don't know. I mean, I'll throw out here's an example of a great oddball stock, and this is tiny. I don't own any of it because it's almost impossible to buy. But Titanium Holdings, so they sell for about 20% of book
Symbol?
value.
Symbol?
It's TTHG, I believe,
Okay.
and they and their market cap's almost all cash. So you're buying a dollar for about 30 cents, and they're profitable. They own a cleaning supply company in Texas. It's a very boring company. It's insanely cheap. You just have to be very patient to get shares.
Okay. All right. We've been on the line with Nate Tobik. He's an investor and founder of CompleteBankData.com. Coming on, talking big banks, small banks, and oddball stocks. Thanks a lot for coming on, Nate. We'll talk to you again soon.
Thanks for having me.